And hello once again, market rebels, and to all of our YouTubers out there. It's that time again for Trading Tune-Up. We do this every Monday at 4 p.m. right on the closing bell. And the idea is just to help you make better decisions, to understand some of the finer points of options and trading. And today, I've got a really special topic, one of my favorites, and that is good gamma versus bad gamma. And this came up because I've been hearing a lot of traders talking about that, doing gamma strategies with all of the volatility in the markets. And people always think that there is a good gamma and a bad gamma. Now, I'm going to cut straight to the punchline right now and tell you that this is absolutely not true. It's a bad viewpoint. It's a bad perspective to think that there's good gamma and bad gamma. Instead, there's only gamma. Now, there are good gamma risks and bad gamma risks, and we're going to differentiate between all of these in this presentation. But again, you will hear most traders refer to good gamma and bad gamma. So let's find out what that's all about and why it's not a real good perspective. So first of all, let's start at the beginning with gamma. What is that? For those of you who need a refresher, gamma is one of our Greeks, and it just shows the rate of change of our delta. So let's say that we have a stock at 100 and we've got a $100 call trading for 5. Broker's platform might say that the delta is a half or 50, and it might also show that the gamma is 0.05. It's going to give us some number right there on our platform. And what that means is that if the stock makes, let's call it a $1 change, that's how much our delta will increase by. So if the stock rises $1 to 101, the delta rises from 50 to 55. You're just adding gamma to the old delta. That's why it's called the rate of change of delta. And conversely, if the stock falls $1 to 99, you're going to fall from 50 down to 45. So notice that it's a direct relationship. Stock price rises, delta rises. Stock price falls, delta falls. That's what it means to have positive gamma. The deltas move in the same direction of the stock. So now let's talk a little bit about long options. Long options have positive gamma. That's whether you're buying calls or puts, you're going to have positive gamma. And what this does when you have positive gamma is it accelerates your deltas for favorable moves, and it decelerates your deltas for adverse moves. And as we're going to find out, this is why people think that this is a good gamma. It makes sense, right? As things are moving in our favor, we'd like to be adding to those deltas, and if things are moving against us, we'd like to be tapping the brakes. So for instance, let's take a look at a long call. In black is our expiration graph, and blue is the current curve. And if we start from over on the far left, we might only have 10 deltas out here. If we go far enough left, we'll have 0. We get towards the at-the-money strike, let's say at 100, we're going to be around 50. The option keeps going deeper in the money, we might climb to 70, and eventually we're going to hit 100. And that's going to happen under two conditions. Either the option has gone super deep in the money with time to expiry, with some time remaining, or it's just a little bit in the money, even by a penny or two, but there's no time remaining until expiration. Both of those conditions are going to push our deltas to 100. But let's take a look right here at the money. Let's say that we have a delta of 50. Stock rises from 100 to 105. You see how we increased 5 deltas? The slope of that blue line has gotten a little bit steeper. It's as if we have added 5 shares of stock to our position. It used to behave like 50 shares of stock. Now it's behaving like 55. Well, where did those extra 5 shares come from? That's gamma. Gamma added those because the stock has moved up. Conversely, if the stock moves against us, let's say it moves from 100 down to 99, we're going to lose 5 deltas, and that's coming from our long gamma position. So once again, this is why traders seem to think that positive gamma is good gamma. It's magnifying those gains when things go right, and it's kind of subtracting from them or guarding against the losses when things go wrong. We can get the same thing with puts. Over here, if we see that we're bearish over here, we get these negative deltas. The line is leaning to the left. So if the stock is way out here to the right, we're going to have roughly 0 deltas. But if the stock starts to fall, look what happens. We start going towards delta -1. So once again, it doesn't matter if you're long calls or puts, you have long gamma. So if there is anything to be said about it being good gamma, I mean, after all, it is a nice property to have. Remember, in the financial markets, you have to pay for any benefits. And so that's you're going to have to pay That's why you get long gamma whenever you buy options. Now, unfortunately, a lot of times people think that gamma can only be acquired through options, and that is definitely not true. It's more of a financial concept. We can get positive gamma or negative gamma in a number of ways. It's just that with options, you get it whether you like it or not. It's a characteristic of an option. But it can apply to stocks. Normally, we say that stock is delta 1, gamma 0. Not necessarily true. So what can happen is that traders can buy share as the price rises, and then you can sell shares as the price falls. And if you do this, if you're a trader who buys into the rising market or sells into a falling market, it's positive gamma. It's just that you're having to take the action, you're having to pull the trigger on when to add and when to subtract, whereas the option's going to do that for you automatically. However, traders could also sell shares as the price rises, and they can buy shares as it falls. It's another tactic we can use, and that would be using negative gamma. This is more of the Warren Buffett approach, and it's also called fading the market, selling into the strength and buying on the weakness. I don't want you to think that either is good or bad, right or wrong. It's just different. What is important is that you identify what's most sensible for you and what are you trying to do. And that should also help to dictate what type of portfolio to run. So with the shares of stock, notice that if the stock price rises, we can create gamma. We can add to our deltas. If the stock price falls, we can work this way back towards to zero. Or what else could we do? We could actually start to short if the stock falls in this direction. So again, if we're buying when the stock rises and selling or shorting when it falls, that is running a positive gamma portfolio. Don't even need options. What about negative gamma? This is where we're going to sell shares as it rises and buy them as it falls. So if the stock price rises, look what's happening to our deltas. You see how that blue line is leaning to the left? That's an indication of negative deltas. But we're pretty close to zero up here where it's flat, so we got maybe minus 10, then minus 50, and minus 100. And we can do this by shorting shares as the stock price rises. Now, if you're thinking, that doesn't sound too safe to me, then you have to be careful about doing a negative gamma portfolio. Again, it's not right or wrong. It's just a different type of risk management, different type of trading. If the stock price falls, look what happens. We might go from 10 deltas, that should probably be 50 or so, and then down to 100. But you see how this blue line is leaning to the right. We are gaining positive deltas. We're buying as the stock price falls. So again, that's this whole concept of negative gamma. So now that we've covered that, now let's get into why people think there is good gamma and bad gamma. Traders believe that long options you buy, have good gamma. And the reason, again, is because it accelerates your gains when things are going in your favor, and it decelerates your losses. But remember that there is a cost. And so here's our risk graph. The blue line is the current curve, and over time, what happens? That starts getting pushed lower and lower, and eventually falls right onto that black line at expiration. So the cost is that if the stock isn't moving fast enough or aggressively enough prior to expiration, that time decay is your cost. So again, there's definitely a cost for having good gamma, even if you want to think of it that way. So good gamma does have a cost. There's a cost for hoping for fast, aggressive moves. Long options decay over time. And if the stock isn't moving in your favor or fast enough, your long options are going to lose. But now what about this concept of bad gamma? There's traders that say that there's good gamma, bad gamma. What they're thinking here is that short options have bad gamma. And again, this is really a bad perspective, but this is how many people see it. And the reason they think that is that it decelerates your gains because you're selling into the strength, and it accelerates your losses because you're buying when things are going against you. So take a look at a covered call. We might have a 50 delta here near the center. If the stock price rises, what happens? We are selling off shares. We might go from 50 to 45 and to 30 and eventually to zero when we're flat. But if the stock price falls, what happens? Notice how that blue line is getting steeper. Now we might go from 50 to 55 and then to 70 and then eventually down to 100. And again, that's just because it's a covered call. We're already long shares of stock. Once this option goes far enough out of the money, it's worth zero, and therefore we're just holding shares of stock with a delta of 100. However, bad gamma has a benefit too, and that's because short options appreciate over time. Yes, you do give up the possibility for large moves, but it's in exchange for consistent appreciation. We know that time moves in one direction at a constant speed. So that's something that you absolutely know is going to occur. So the main thing to get from this, again, is that there is no good gamma and no bad gamma. You've really got to get that out of your head and out of your vocabulary. It sets people up for just bad trading decisions. However, there is a good gamma risk. Okay, that's different from saying good gamma. Notice I'm adding the word risk. There is a good gamma risk, and that's whenever the value is greater than the price, or the cash that you're receiving is greater than what you paid. And that's going to occur if you are buying at relatively low implied volatility or selling at relatively high volatility. In the first case here, you're buying, that's positive gamma. Second one, you're selling, that's negative. But both of them have good gamma risk because we're doing it for different reasons other than this preconceived notion that there's just good and bad. There are certainly times that we would want to take long and short volatility. What's bad gamma risk? Just the opposite. This is where the value is less than the cost. So if you're buying at high implied volatility, the amount you're paying is probably a lot more than what you're going to receive. Or if you're selling at low implied volatility, that's really a bad gamma risk. Now, finally, the last thing, and probably the most important that I want everybody to understand, is another risk that we call a forced gamma risk. And what happens here? Well, for negative gamma positions, options that you sell, the question is, are margin calls going to force you to close positions? Because if that happens, you're buying these options to close when presumably the implied volatility is through the roof. So not only did you lose on the direction, but you got completely waxed on the amount that you had to buy back these options for. That can be a very bad risk if you are being forced to close these negative gamma positions. For positive gamma, question is, will daily decay force you to close positions early before they might pay off? This is why so many people load up their portfolios with long options, and then after 1 or 2 days, they watch the value tick away, and then they close them. And 6 or 7 days later, the stock makes a big run, and they go, oh, I should have held on to it. But they're not managing these risks. So the main thing to realize in these situations is that risk is managing you. And so that's really the thing I wanted everybody to understand. Get the concepts of good gamma and bad gamma out of your head. They're tools, they have pros, they have cons. But there is good gamma risk and there is bad gamma risk. And the worst of the bunch is a forced gamma risk. So one of the things that you want to kind of check with yourself or talk to your coaches about is, what is your philosophy? What are you trying to do? Are you willing to buy as the stock price goes up to add shares? Are you trying to sell as they go down, or the opposite? And then find out which type of trader you are, and then figure out if you are using the correct tools to accomplish that. And so I hope that helps. But as always, the idea here is that you want to understand options, not just think that, oh, you buy a call because the stock is going up. There's far more to understand. And if you don't understand these technicals, this is where you're going to step into traps, or you're just not making the most of your options trading. So for people who'd like to learn more, please take advantage of this offer. It's absolutely a great deal. Free 30-minute one-on-one assessment with one of our world-class coaches. And in fact, this Thursday, you're going to meet Scott Thorstensen on Coach's Corner, another one of our coaches. And of course, Stu will be with us. But this is a $100 value. Pick a topic. They'll talk to you about anything that you want and can show you how they can help you become better traders just by having a different perspective. So the phone number there is 888-809-8058. So please give them a call, take advantage of that awesome offer. And with that, I hope that I gave you some things to think about and that it helped. And then we hope to see you on Thursday, 4 p.m. Eastern Time for Coach's Corner. We'll see you then. Thank you so much.